All right, today we are going to look at a whole life insurance policy that was started in 2015. We'll look at how it's performed, how we track the actual performance, and what things look like moving forward. So this is a policy for my friend Greg and his wife. He started the policy back in 2015. The official start date was July, and it is a survivorship whole life insurance policy. All that means is it is one policy on both him and his wife, and the death benefit does not pay out until both of them pass. He selected this policy, one, because he does have enough life insurance and he's in a position where if something happened to one of them, they don't need the death benefit on each other. And the cash value sometimes looks very, very good with survivorship policies. Single life policies can in many cases provide very similar results. It does depend on how much we're funding and how long we're funding, but in his case, it looked pretty good. So he received the top health rating. She received a standard non-tobacco. The original plan was back in 2015. He had planned to fund his whole life insurance policy with $150,000 per year for 3 years. Then he wanted to drop the funding to $125,000 per year for another 3 years, then down to $50K, and then after that, stop or pay the premium as long as he felt that he wanted to continue to pay the premium. He could pay it up until he's 100 years old, so pretty much forever. So we could see the guaranteed cash value, but really what we want to look at here is the total cash value. So the break-even point is when? Well, by the 3rd year, he would have paid in a total of $450,000, and the projected cash value was $440,000. And by the 4th year, he would have paid in $450,000 plus $125,000. That'd be $575,000, and look at that. There was the projected break-even. So did it actually break even in policy year 4? We're going to take a look. What I'll say is that his actual funding did not follow this exact schedule that we see. How we track policy performance is we look at how much a client has paid each year, and then we reference their annual statements. So the annual statement shows you the total cash value year over year. We can see with this older product that's been discontinued, the insurance summary, which gives you a summary of the total amount of death benefit, it's $4.2 million, and then the cash value summary, which is what he's been interested in the whole time. That's why I put a lot of money into the product. A couple of things here I want to highlight, because in the first year, he did not take any loans. We've got 2 types of cash value here. You see basic policy cash value, and then fully paid up additional insurance. Both are under the cash value summary. In the first year, you see nothing shows up under the basic policy cash value section, and everything we have is under the fully paid additional insurance section. That's your PUA rider. So the total cash value is nice because it tallies everything together, but why there's no basic policy cash value, or what that is to start here, is the cash value that is generated from the base premium payment. His base premium is just about $15,000 per year. You can see that at the bottom of the original illustration right here. There's his base premium. So in the first year, that builds nothing in terms of first year cash value. Okay. First year cash value, he was at $128 and change. Second year, he's at $273,000 and change. And we see through the second year, the total cash value consists purely of his PUA payments. It wasn't just the first year, but it was the first and second year that nothing of that base premium showed up in cash value. A lot of times people wonder why it makes sense to drive that base premium as low as possible, because it doesn't give you any cash value up front. So you're starting out further and further behind. The more you reduce it, the less of the hit you have up front, which results in more cash value up front and long term in most cases as well. So this is 2 years in, 3 years in. Look at this. So 3 years in, the base premium starts to build cash value, and he's still adding money into PUAs. He also takes a loan this year of about $288,000, which gives you a total cash value of $147,000. Here's the big thing though. With a life insurance policy, he's earning dividends and interest on this total amount right here. Meaning, even though a loan is still outstanding, he's getting compound interest on the entire cash value. So for example, if a loan was not outstanding, that total cash value would be the basic policy cash value plus the paid up additional cash value, which would be $435,000 and change. So what we do is for years that there's no loan outstanding, we take the total cash value, and for years that there is a loan outstanding, we take the basic policy cash value and paid up additional cash value and add them together, because that gives us our true total cash value that is earning interest. So we do that for each year. Here's a good example for 2021, because he had paid all of his loans off. So if you were to add these two together, they'll give you the total cash value. In fact, we can do that very quickly right now. 61,284.6 plus 698,568.33 gives you 759,852.93, which is the exact number you see under the total cash value section. Sweet. Okay, cool. So we can look at each year all the way up through 2025. We can look at the annual statements and take a calculator and track the actual performance, or we can just use one of my favorite tools on the planet, Microsoft Excel. So what I like to do here is take all of the information on the annual statements and export that to Excel. This creates what I like to call a live illustration. Sometimes I'll call it a historical illustration, and it really shows us what's actually happened over time without having to flip through annual statements and look at all that good stuff. So if you go back, you'll notice that these cash value figures match exactly what we saw on the annual statements. First year, 128 and change. Second year, 273. Third year, 435. Let's check something out here, because the original illustration assumed 150 for 3 consecutive years. So if I'm him, what I would have done is took that original illustration and cross-referenced it with my actual cash value in year 3. Let's take a look, shall we? So it showed 435, 786. That's what actually happened. If we go back to the original, what was it? 439, 682. That's less. About $4,000 less. Why so much? Has to do with the dividend rate coming down a little bit, but it's come back up. Anyway, in year 4, the original plan was to fund 125, but he paid 150. So now the original illustration doesn't really work as a reference because he's paid a different dollar amount. This is where we solely just pull the data from the annual statements and put them here. But here's what he did. Paid 50 for 1 year, then 35 for another 3, and then just the minimum premium of about $15K. And then he stopped paying. So right now, he's in policy year 12. This started July of 2025. It'll end July of 2026. So he's in policy year 12. He has not been paying anything in. His total input thus far is about $770,000. That's his total out of pocket. He's got some cash. Like, look at this thing. It's compounded without any risk. What has it actually grown by, though? Here's the dividend rate. Remember where I mentioned $4,000 less in year 3? That's the main reason why. From the time he started through year 3, that dividend came down quite a bit, 70 basis points in total. That is when all companies were gradually coming down. As we look at it, what happened here? It has started to recover, which is nice. Continuing on, we've got the annual yield. we could just delete the dividend column if we want, because that is a gross rate. The annual yield shows him the true year-over-year return on cash value. This is what he's been interested in. First year is the worst year. Second year is not good because I'm still in the red. Year 3, he earned 3%. Think about that. That's 3% in 2017. What were you getting in the bank? 0.3%, not that much. Each year, it's gotten stronger and stronger. When COVID hit, and remember in March of 2020 when the market just tanked, I remember talking to him and I'm talking about the market. I'm like, yeah, it's really taking a dive. He goes, it is? I haven't looked at it because he doesn't put money there. But here's what he enjoyed. In 2020, 4.9%. 2021, 4.86. 2022, 4.84. Then starts to come back up. He stopped paying. Dividend rates begun to come back up as well. The policy is seasoned now. It's just cranking. And again, these are actual results. Year 12, we'll cross-reference the annual statement when we get it next July, but it is moving forward. Like all of these values are pulled directly from the annual statements. If we want to look at the internal rate of return and the average, we can look at that guy as well. That'll continue to get more attractive. And if you prefer dollars, we can look at this, the cash value growth year over year, which is really just the annual yield in dollars. The last thing we like to do when we prepare these for clients is see what things look like moving forward. So everything underneath the red line is based on the current dividend rate for 2026, 6.60%. That is going to change, just like it has changed since he started the policy. But what I like to do with these is measure them year over year and then cross-reference what did the past projections look like compared to the actual results. And for a life insurance policy, which grows safely, he can access anytime, which he has over the years, and is also tax-free if we follow IRS rules, which we have the whole time. It's quite attractive. This has really complemented his portfolio, and he's used it for opportunities. The first thing he used it for, I remember him saying, was a townhome purchase that he invested in with his son, which is always cool to see. The product works quite nicely. I like this policy because it validates it. We've got some proof of performance, especially with all of the negativity in the world of whole life insurance. I hope you enjoyed it. Please let us know your thoughts and any questions in the comments below. And as always, I hope this helps.